Hello dear friends. This is Alex, the beginner investor which invested in copy trading using Etoro platform. You can do the same using the link below. While his investment is growing, he can spend some time in studying the investment world. In one weekend, Alex goes with one of his friends to the store. They both want to buy a TV set. They both like the same TV. It costs $1,000. That is a little bit too expensive, but Alex's friend doesn't really care about money. He buys the TV. Being a little bit more careful with his money, Alex decides to wait for some discounts. While waiting for the discounts, Alex gives this video a thumbs up and checks to be subscribed to the channel. Make sure you do the same. A couple of weeks later, the discount period comes, and Alex is able to purchase the same TV at a price of $700. What a great feeling when you are able to get a product at a cheaper price. But wait a second. Why would not this principle be applicable also for the stock market? Well, it is. The concept is known as value investing. Value investing is the art of buying stocks which trade at a significant discount to their intrinsic value. Value investors achieve this by looking for companies on cheap valuation metrics. So, how does this work? Let's take a look at a stock chart. The blue line represents the stock price evolution over time. It is easy to figure out that company itself does not grow or decline so fast as the stock price moves. This is because the price is often influenced by emotions, such as fear or enthusiasm. So, let's draw a second line which would represent the so-called intrinsic value or true value of the company. Now, we can see that there are regions where the stock is trading under, or over the company's true value. Buying the stock when it is undervalued, is similar to buying the TV set at discount, as Alex did. But beside the discount, an additional important aspect is that the value investors strongly believe the stock price will come back to its true valuation after a period of time. But be aware, it might take years before it comes to its true valuation. Thus, the patience and diligence is the weapon of a value investor. You cannot expect bombastic returns overnight, it is a slow and steady strategy. The question is, how to evaluate the intrinsic value of a company? There is no discount label attached to them. Well, there are a couple of indicators which might help. Let's start with price-to-earnings ratio or PE ratio. Assume there is a company A, which has high earnings per every share, known as EPS. And there is a company B, with lower EPS. It comes obvious that company A has higher intrinsic value in every single stock outstanding. Now, to determine the valuation, we have to divide the share price by EPS. Let's say both companies' stock price is $100. But company A has a earnings per share of $5, while company B has an EPS of $2. Doing the math, we see that company A has a P ratio of 20, while company B has 50. In real life it is not that simple because EPS come in many different species, but you got the idea. The lower the P ratio is, the less valued the stock is. Fortunately, the P ratio is a public information which you can see also on Etoro on the corresponding stock page. In order to determine if a stock is over or undervalued, we need to compare its P ratio to the average P ratio of that sector. This is one of most used methods. It is worth looking at some examples. Here is a first set of stocks. We can see that all of them have a P ratio which is lower than their sector average. All these stocks are undervalued. Now here is a second set of stocks. We can see that all of them have a P ratio which is higher than their sector average. All of these stocks are overvalued. Beside PE ratio, there are also other indicators which help to evaluate a stock. PEG ratio or price per earnings growth. This is simple, the P ratio divided by the earnings growth. It is used to determine a stock's value considering also the expected earnings growth in the future. So, it provides a more complete picture. A lower PEG indicates that a stock is undervalued. PB ratio or price to book. This indicator measures the value of a company's assets and compares them to the stock price. If the price is lower than the value of the assets known as book value, the stock is undervalued. PCF ratio or price to cash flow. This is an indicator that measures the value of a stock's price relative to its operating cash flow per share. A low PCF ratio may imply that a stock is undervalued in the market. These additional indicators are also public. I am going to show you how you can find them on SeekingAlpha. You can access SeekingAlpha using the link below. To find the stock you are interested in, just write its name in the search box. Once you got on the stock's main page, you can see multiple sections are available. Make sure you explore them after watching this video. For valuation metrics, go to Values section. As simple as that, you got all the described indicators, plus some extra metrics. Furthermore, there is given also the sector average, so that you can make a comparison. SeekingAlpha turned for Alex to be a very useful instrument for his investment adventures. That's probably enough for today. Start investing using the link below, leave your feedback in the comments section and don't forget to give this video a thumbs up and subscribe to the channel. See you in the next episode where we will talk about growth stocks. Bye bye.